Okay, so timing the trade. We just talked about the 3 ways of getting on board that trade. Number 1 is we draw a small trend line. Let's get the drawing thing out. So we draw that trend line. Oops. We draw the trend line on the. So there's the counter trend move. There's the drive. This is the trend line we draw in with our drawing tool. And then as the price breaks that, we're looking to go long at that point. Great. We know what that's all about. The other method, or the other way of adding to this, is that we look and watch our moving average, our 20 period, catch up to it. In a perfect world, that catches up to price and just gives it a springboard ability to just drive off that. Very lovely when we get that type of scenario. And then the final thing is we wait for a let me just change the color on the pen. We wait for a little wick to form on our candle. So there's our candle. If we get a wick to the downside, it means that price has changed direction in that 1 minute period, and it gives us a marker to trade against, because if we get that and we take a long, we know that we can put a stop below the low. And I've also mentioned here about a little bit of watching institutional buyers selling on the tape. That's a little bit more advanced and something that can come later on, and I don't want to go into that now. I want to keep things simple and clear, but something we can do. So important aspect of this is risk management. Where is our stop position? Now, it's a big thing with trading. We want to make sure that we do not take on more risk than necessary, but at the same time we need to give the market room to breathe. So the stop position is going to depend on the strength of the move. We're obviously not going to take this trade if it's a quiet drift up higher. That's not the point of the trade. We need that very strong move, and the stronger the move, the tighter the stop. Because if we think of the supply-demand imbalance, the seesaw type effect, if we're well out of balance and we know, hey, the buyers are just monstering this market up, they're pushing it higher, any little retracement is going to be bought straight away. We can afford to use a tight stop, and I love those scenarios where the balance is so out of sync that we get the opportunity to get in an aggressive trade looking for another leg higher. If it's a good move, but it's not really a massive move, it's still good and it still passes the trade criteria, but doesn't really drive us aggressively, we're going to have to give ourselves a little bit more room. Don't forget, guys, the point of a stop is it takes us out of the trade when we're wrong with our trade thesis or trade premise. It doesn't take us out of the trade just based on noise. So the important thing of this is that don't be afraid to take a small stop and re-enter when price action confirms. You don't want to be caught out on this sort of thing, a V-shaped reversal. So if you have taken, they've got to pull back, the price has then broken above that trend line, you've gone long, put your stop under there, come out, reassess it. I always use the low or high of the counter trend move plus or minus a few ticks as my stop. That's why a wick or a tail is so good, because when you get that move back up in the direction of the trend after you've had the counter trend move, you can use that low to lean on as your obvious stop position, and definitely always come out of it and look to reassess. You don't want to be caught out in that V-shaped reversal, as I say. So always recognizing that it's important to manage the risk. So where do we put our targets for this trade? We know we're looking for a drive, a pullback, we've got our stop position. Where's our target? Now, if you're right on this trade, you're at least going to retest that last swing point, whether it's a high or low. High, obviously, with an uptrend, low on a downtrend. So that's a good place that you can use as a risk off point. So when I mean a risk off point, I'm talking about scaling. So if you're in at, so let's say £4 per point, and the market moves back to test that high, you can take off 2. You can leave 2 on. You don't have to take all of your position on or off at the same time. You can scale in that position. So scale out as the market comes up to that point. Take £2 a point off. You've got half the position on. Now you're in a little bit more of a comfortable position. You can scale as the market drives even higher. So as it pushes higher, you scale off another one. As it gets momentum and really pushes and get those extreme moves, you scale off another one. That is how you work your trade. Not all in or all out, scaling into those pulses. And it's good because what you're doing is you're taking the other side of traders getting stopped out. The guys who are short and they're caught on the wrong end of the move that's driving higher, you can sell it to those guys because they've got a sell stop obviously because they're short, a buy stop because they're short, and it's causing a little bit more panic, a little bit more momentum. Utilize that to your advantage. Scale out your long trade into those. And also, It's important. Extra thing to note here is that it can often be the start of a very strong move. So if everything is lining up nicely, it's a good time to look for those extended key levels that you did mark off pre-market. We talked about looking at higher time frames and say, you know what, this is a big move. We've bounced off the lows aggressively. We've got a good move. It's the first pullback. We could close on highs for the day. I need to consider whether I should be holding my trade for the rest of the day and letting the market pay me. There's no right or wrong way for this, but this is something that you need to look at as a trader and assess the situation individually.